Hey everyone, in this video, I'm going to bring you one growth stock that's down 79% off its high that I think makes an excellent investment for 2024 and beyond. This growth stock is one that I used to own, although I don't own it anymore. In this video, I'll share with you why I don't own it anymore and why I'm considering it again now that the valuation is more favorable and some of the things I was concerned with have kind of played out. So I'll share that with you as well. So let's jump right in. Let's see what the growth stock is and why I like it for 2024 and beyond.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the growth stock that I am talking about in this video is Chewy. Chewy is the stock that I'm talking about, the online pet retailer. Now, I used to own this stock, but the reason I sold this stock, and I sold it a couple of years ago, was because I started seeing trends where it went against my thesis. My original thesis for Chewy when I made my initial investment was during the pandemic, millions of people became pet parents. They adopted a pet, they brought home a pet during the pandemic because they were spending more time at home and some people wanted more companionship while they were at home. But what troubled me was the trends that I saw about a year or two after the big boom in pet household formation was that people were starting to bring back their pets. They were returning them, and that was troubling to me. I thought initially, and this is usually the case, when people get a pet, when they bring home a pet, that's a multi-year investment, right? You're not getting a pet for a few months. You're getting a pet, if it's a dog, for maybe 10, 15, maybe 20 years, right? And so I was thinking that's going to be a Chewy customer for 10, 15 years. And that was my bullish case. But when I started to see pet households shrinking or returning pets in a stronger than expected number, I said, I better get out of the stock right now before these trends worsen. So that's why I got out of the stock. So now let me share with you why I'm starting to like the stock again. So the reasons why I liked the stock to begin with was because management had done a good job growing the business and growing the business effectively. In the most recent quarter, net sales increased by 8.2%, which was less than the 12.3% net sales have increased so far in 2023. So the growth rate is slowing down. Also, active customers shrunk from the previous quarter and the previous year. Chewy now has 20.266 million active customers. That was down from 20.5 million active customers in the same quarter the prior year. Chewy management has been talking about this, that they're still attracting new customers, but what's hurting them is that big bulk of customers they added in 2020 and in 2021 when people were shopping more online. They added millions more customers than usual. And so the usual churn, right? When you add a million customers, maybe 500,000 stick around, maybe 750,000 stick around. So you're losing some customers, right? Just typically in the course of business that happens. Well, that shrink from that strong base is causing an overall decrease in the customer count. Even though Chewy is adding new customers, the net growth is still negative because those churn rates from previously added customers is higher than usual. Still, look at the customer engagement. Net sales per active customer increased by 14% to $543. Each Chewy customer spends about $543 a year with Chewy, and that grows over time. So when they're a customer at Chewy in the first year versus the second year, they spend more in the second year versus the first year. And then in the third year, they spend more than they do in the second year. And in the fourth, they spend more than in the third. And in the fifth, they spend more than in the fourth. So as people grow with Chewy, they spend more with Chewy, and that's great news. Also, Chewy gets a significant portion of its revenue automatically. They have what's called auto ship, which is similar to subscribe and save with Amazon, where pet parents just say, you know what, this is my dog's favorite food. we want this every month. Just send it to us every month. And they subscribe to it. And every month, Chewy sends them the food. 76.4% of Chewy's sales comes from its auto ship segment. That's valuable for a number of reasons. Number one, it makes the customer stickier. They don't have to make a new sale every time. That sale is automatic. And so the customer's probably not going to cancel that order if they've still got that pet. That's why it's so important for pet household formation. And also it helps Chewy manage the business. If you know there is this many customers that are going to get this product at this time of the month and you need to send it to this location, and you can plan your business based off of all of those already planned shipments, it makes it easier for logistics and you can lower costs and you can optimize, which is precisely what Chewy has done. Let me show you that. So Chewy has demonstrated economies in scale. Economies in scale is one of the most desirable characteristics you can find in an investment. In the example I have created here, sales grow from $100 in year 1 to $115.76 in year 4, while net income more than doubles from $4.50 to $9.47 in year 4. This company demonstrates economies in scale. As its revenue grows, its profits grow by a larger magnitude. Not every company can achieve this kind of effective growth. Here's how it works. This is a typical categorization of an income statement of a publicly traded company. Cost of goods sold is what's called a variable expense. That means cost of goods sold is connected to sales. Other expenses like interest, general and admin, and depreciation are not connected to sales. You can see here depreciation stays the same at 25 whether sales increase or not. The same is true for interest expense. It stays the same whether sales grows or not. You can understand your interest payments do not increase when your sales increase. Overall, businesses typically have a mixture of fixed expenses that are unrelated to sales and variable expenses that are. When sales increase, the business leverages those fixed expenses, as we see in this example, and profits grow by a larger magnitude than the increase in sales. That being said, let's look at the operating profit margin, which has increased from negative 8% in 2019 all the way up to 0.11% in the most recent trailing 12-month period. All of the factors that I've discussed already in this video led to this happening, and management has been good at dealing with the ups and downs with the business, because that's not an easy thing to do, to deal with the pandemic, even though it came with a boom initially and then a bust, not a bust, but a downward, a slowdown in growth. It's not easy to deal with, and I think Chewy has done a masterful job. Similarly, cash flow from operations has grown nicely over the years, 487 million positive in the trailing 12 month. That's up from flat-ish around 2019. The company well on its way to be self-funding. Also, expectations are for Chewy to grow revenue at 4.9% in 2024 and 7.5% in 2025. Number one, that's an accelerating growth rate, which I always like to see companies grow at an accelerated rate. The second derivative I talk about a lot. And number two, the growth rate itself is not too optimistic, right? 4.9% growth for an online e-commerce retailer that's just getting off the ground, that just launched in Canada, that might expand in that region. So I like that the expectations are not incredible, right? And that's included in the valuation. So because the expectations are not like robust and incredible, the stock price is valued accordingly. And I like that. I like getting into a stock that doesn't have these incredible expectations that it needs to execute on. And so this is partly why I'm revisiting Chewy stock and considering it again. And I talked about valuation. Chewy is trading at a forward price to earnings of 36.38, which is near the cheapest you've been able to buy this stock according to this metric since early in 2021. So yes, they've got some factors that are not great, right? Losing customers net on a net basis. The change in profitability, Chewy was profitable net income on the bottom line in the same quarter to prior year, while they were not so in the current quarter. Management did address that. They did make some cost cuts to improve that metric. Overall, I think the capability management has proven the market for pet spending, the household spending, household formation for pets, and the humanization of pets trend is leading to increasing household spending, as you saw with the net active spending per customer. So all of those are leading me to recommend Chewy stock as a buy for 2024, and one that I'm considering as well. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.